We are recording. Okay. Sorry for the delay there. Welcome, everyone. John Hutchinson John Hutchinson, not with anybody today. I'm usually, not flying solo all the time. Live with Traders Reserve and our IQ special. This is a little bit of a preview of some of the things we'll be discussing at this year's Investors Blueprint Live, but I have two critical topics, regardless of whether you're attending Investors Blueprint Live or not. They matter, and these are two issues that are happening now, and I want to share them with you and show you an idea for how you can combat them in the months ahead. So we'll move as reasonably brisk as we can and try and be in and out of here in about 30 minutes or so. So let's get started with our first topic of the day. And while financial media have largely kind of been asleep, the yield curve has uninverted 3 times. And that is important because given the current economic conditions of a slowing economy, the Fed trying to navigate a soft landing or no landing, which so far is what is happening, the yield curve uninverting or turning positive, where the 10-year yield has a greater or higher yield than the 2-year Treasury, 10-year Treasury, higher yield than the 2-year Treasury. Historically, that has not been a positive event for the S&P 500 or the major indices. And at the same time, as this is happening, we have the Federal Reserve meeting on September 18th. That is a key FOMC meeting. That is a rate policy setting meeting, which happens on the quarters, March, June, September, December. And it is widely expected that the Fed will cut rates. The question is whether they will cut a quarter or a half point. We'll cover the importance of that in the next slide. But for the moment, I expect the Fed to cut a quarter point. I don't expect the Fed to cut a half point, and that will be met with, or that will be viewed as disappointing. So don't be surprised if you see some volatility by Wall Street following that September 18 meeting, if the Fed cuts by a quarter point. A quarter point is basically the guarantee right now. Even at Jackson Hole, without expressly saying it, Fed Chair Powell said essentially rate cuts are coming. But I didn't build this in as a slide, but earlier this year at the Investors Blueprint Live in February, we told you that the Wall Street was expecting 4 to 6 rate cuts per year. We told you we did not see that happening. It hasn't. Back in February, Wall Street was predicting the first rate cut occurring in May. We told you we didn't believe that that would happen either. Now, here we are in September, and the market is projecting a 1.5% in total cuts between September and December. That's far too aggressive given the actions of the Fed and, frankly, what's known as Fed speak, the way that the Federal Reserve board members and governors talk to the media doesn't feel realistic to me. And the biggest point I want to make for you is this: you do not want the Fed to execute panic policy. That's a half point or more in multiple rate meetings, and I'll show you why in just a second. But going back to or combining that issue with the yield curve turning positive, in the years 2000 and 2007, which are the closest to the type of economic conditions we have that I was able to marry up to the last time the yield curves uninverted. We all know what happened following 2007. Those economic conditions were at that time in 2007 similar, but not the same. It was the forefront of the mortgage crisis and the housing crisis, and then which became the Great Recession in 2008 and into 2009. 2000 was a little closer to a normal recession, but that was on the back end of the dot-com collapse. So a significant event in the stock markets, which rolled over into the economy. But those were the two closest events that I could find. 2019, when the yield curve both inverted and then turned back positive, didn't have the same types of conditions in place, but that was a period too where the yield curve changed. But it wasn't as it was neither as extreme as it has been. The yield curve has been inverted for 2.5 years, which is the longest on record that I'm aware of. Excuse me. And more importantly, in the 2000 and 2007s, periods, you could see the stock markets or S&P 500s record in the 20 plus months following the turn of the yield curve was deeply negative. Not predicting that, not telling you that's what is going to happen, but it's a marker. It is something as an investor, as a trader, that bears watching. We've already seen a shift, a substantial shift in the markets since July. And if you are wondering where all of the money went when Wall Street sold off big tech back in July, I found it, and I'll show you where it went in just a couple of minutes. But ultimately, also going back to the beginning of the year, and even as we have come through the last 6 weeks or so, since 8 weeks since July earnings, the one thing that I keep coming back to is Wall Street's expectations are unrealistic. They keep pricing the stock market for perfection. Perfection isn't happening. If you look at Nvidia and Broadcom's earnings in the latter stages of August and early September, both companies took significant hits, 5, 6, 7, 8%, while reporting above expected earnings and above expected revenue. But in both cases, and in multiple cases, what's happening, why I'm saying that Wall Street's expectations are unrealistic is because they're forecasting 10 to 20% revenue growth in the middle of a slowing economy. And while companies like Nvidia and Broadcom both projected better revenues moving forward, those expectations were below where Wall Street was setting their expectations. And it's a big difference. And so that's why we have this push-pull in the market. So markets were up again today after being down substantially last week. And another key is, and even if you look at a longer term chart, you see Dollar General has taken a beating. If I remember correctly, off the top of my head, Dollar General was trading in the mid 200s and is now trading at 80. That is a key stock for the lower end of the economic spectrum. When companies like Dollar General and other stores like them begin to have difficulties, when they start saying our forward guidance is being lowered, the next thing to start watching for are companies like Walmart, Target, companies along the middle tier, right? The middle of the economy or of the economic spectrum. If we continue to see this moving up of reduced forward guidance, that begins to build the case for recession. Another company, Elf Beauty, ELF, reported better than expected earnings, better than expected revenue, but their stock took a massive hit because Elf rolled out a low-end product that actually doubled their sales. So their sales revenue from that product were 100% more than was projected. But it is a low price, low margin product, which decreases their forward earnings projections. And the stock has taken a roughly $40 hit from the 180s to the 140s. So you're starting to see cracks in different areas of the market, from tech to consumer, that are causes for concern. And against this backdrop of the yield curve turning positive, it's a warning sign. It's an alarm bell, right? That's all it is for the moment. Coupled with this idea that I have sharing with you of the Federal Reserve, and what I think you really want to see is the Fed sticking to gradual rate cuts, even through the rest of this year, even if the economy slows further. The economy is still growing. It is growing at a much slower rate now than it was at the beginning of the year. But when it comes to Fed policy, looking back, and again, there are no periods where you have exact similarities, but they rhyme, right? That's the old maxim is Wall Street history doesn't repeat itself, but it often rhymes. And in this case, we can see a couple of rhymes where the Fed has to navigate a challenge in heading off a significant or severe recession at the same time that they are battling to continue to decrease the rate of inflation. In the closest matching periods that I've been able to find, which are 1995, 98, 2001, and 2007, periods where the Fed enacted different types of rate cuts, either gradual or aggressive. You can see the significant difference in market performance in the 3-month to 24-month periods that followed the first rate cut. In the 2001, 2007 periods, both were recessions. One was a significant recession, obviously, 2007. 2001 being more of a standard recession, if there is such a thing. But in each case, markets were largely negative. And compare that to the 1995 and 1998 rate cut periods, where in each case those were gradual, where the Fed reduced or cut rates by a quarter point in successive meetings, and you can see the performance was largely positive. In the context of where we are right now, 1995 is the closest match to economic conditions and to what the Fed is trying to navigate. That is heading off a recession, managing or affecting a soft landing, which they did accomplish in 1995, and leveraging gradual rate cut policy, even against the backdrop of the slowing economy. So what we would like to see as investors is a Fed that does take a slow and steady approach. By gradual rate cuts, they are not going to rapidly change the rate of inflation. They should not, while at the same time slowly unlock the key market right now. Labor hiring is slowing to stopping, but firing is not increasing. In other words, over the last several weeks, the weekly jobless claims reports have returned back to the lower 200s, 200,000s, excuse me. And that's where they have been largely throughout the course of the year. So we're not getting a significant uptick in weekly jobless claims, which scared the market back in early August, even at the same time as the monthly jobs reports have come in weaker than expected, both in August and for the July and August periods, the August and September reporting periods. I hate those monthly after reports. It's like, just tell me what the month is. So at any rate, this is why I wanted to share this in where we are right now, because in one sense, this helps you to see that the volatility in the market is being driven by expectations for rate cuts, the continued battle against inflation, and certainly economic conditions. But at the same time, the bond market is signaling less confidence or lower confidence in economic growth forward. So this creates, in essence, competing issues. We won't know until time passes how this will play out, but knowing in advance what's possible, not predicted, but possible, gives us a better way to think about how do we want to allocate capital. How do we want to manage positions, take on new stocks or not, or even exit stocks or raise cash, right? So these are the types of questions that you want to ask yourself, and we'll do what we can to help you answer them. But more importantly, it's like this is where we are, and because of these two primary issues colliding at the same time, this is a more unique period. Given both occurring roughly at or about the same time, both the yield curve turning positive and the Fed enacting rate cuts. To that end, want to take a quick look at valuation, because over the last couple of weeks, with the lower move last week, The Wall Street pushed forward valuation for the S&P 500 back down to around 20 times next year's earnings. That's 2025 earnings, which are forecast for the full S&P 500 at $270. That's earnings per share. But the key here is that August rally, that the post August 5th rally, was a low volume rally, and those don't usually end well. As Wall Street got back to work after Labor Day, we saw they pushed back against that initial rally. Yes, the markets were up today, but I want to keep my eye on two key lines, which are basically the 5,300 and the 5,000 lines. Do not be surprised if we trade back into that range in weeks ahead, especially post-Fed. And long term, if we were in a worst case scenario, which we're not, we want to keep our eye on about the 4,600 line. Those three lines, those three levels are key levels of long-term or longer-term support and resistance. They're far apart, obviously, but each of those on the way down would be what I would call breakers, right? If each line, excuse me, if any line breaks, it puts in play the next line down. I'm not predicting that. I'm not telling you that the world's going to end or anything like that. But this is where our attention needs to be, because does Wall Street sort of level out in between the roughly 5,400 range, move sideways? That would be a more acceptable response. Or do we get a much stronger volatile response to the Fed's actions in the weeks ahead? And we also have October earnings coming up. That will do a lot to inform us. So again, we have competing historical data between the yield curve and rate cuts. One is positive and one is negative. The next 2 months will really tell us which of those is likely to play out into the near future. As well, I'll continue my discussion or a discussion on valuations in the next session that we do with IQ, just looking at what happens in typical recessions or recession-like periods. So if the economy continues to slow further, where is this market likely to fall to? And we'll dive a little deeper into that. And then how could you potentially play those types of moves lower and or higher in the next several months? But another option or another choice is to take a more defensive approach with a segment of your capital. This is a different form of hedging your portfolio. That is owning a defensive sector where Wall Street tends to hide in times of chaos. But this one is unusual in two ways. Number one, because even in a slowing economy, this one sector has rising demand, and that is the regulated electric sector. The growth in delivery demand has been affected by, obviously, the rise of AI in the last year, and AI computers, AI data centers, AI servers, AI software, all types of digital storage data centers. Iron Mountain is a good example. IRM is a good example of a digital storage data center. Electric vehicle, meaning the plug-in stations, the irony of renewable energy is they still have to get their electricity from somewhere. And those are from regulated electricity companies. And crypto, if you're familiar with crypto mining, if you're not, I don't recommend worrying about it right now, but that is also a significant driver of demand in the energy market. And I told you a couple of minutes ago that I found where the money went. Well, if you go through about 10 or 20 stocks in the regulated electric utility sector, you will see that many of these stocks are up anywhere from 8 to 15% in the last 2 months. So at the same time that Wall Street was selling off big tech, here's where the money went. This is one sector where the money went. It's not the only sector, but it is one sector. So since this is not likely to abate, it's not going to end, this is a defensive sector that you could add to your portfolio temporarily, might be for 3 months, 6 months, or 12 months. and take advantage of the short-term momentum which is occurring in this sector, and use it as a way to hedge your portfolio by using reasonable amounts of capital, might be 5 or 10% of your overall portfolio, centered or structured around a few positions. One caveat, I'll come back to it here in just a second. This sector is not the greatest for options traders. So bear that in mind. It doesn't mean you can't trade options on them. It just means that the demand for options is not as great as it is for tech stocks or other financial stocks or other stocks. So not the greatest sector for trying to generate income using options, but most of the companies here do pay dividends, so that can help. But with trends like the one you see on the chart here, this is the XLU. This is the simplest way as an ETF to play the sector without having to research individual stocks. The XLU trades over 10 million shares, average daily volume, $17 billion in assets, a very low expense ratio, or at least a reasonably low one, a 3% dividend yield. I believe the next, by my calendar, the next dividend should be, ex-dividend date should be the week of September 24th. Excuse me. The XLU is also up 22% year to date, which is outpacing the S&P 500. And most of that gain, as you can see, has come in the last roughly 90 to 120 days. And even when the XLU fell off, these are, each of the box bars on the chart are months. So you can see going backwards, August, September, excuse me, backwards, August, July, June, and the mid-May to end of June period when the XLU declined. It was a $4 move, top to bottom, roughly a $4 move. So it's not extremely volatile. I mean, nobody wants to take a $4 loss, but it's not declining by 10 or 15 or 20%, like most tech stocks did back in roughly the same in the period in July. And as it has rebounded back off the 68 line, it's moved up nearly 10%, a little more than 10%, excuse me, in just the last 60 days. And you can also see the two big red bars at the beginning of August. The overall move was a little over roughly $2. So while the rest of the market was really hammered following the jobs report, et cetera, at the beginning of August, yeah, a little bit of a hit, but not substantial, and turned around and rebounded along with most of the rest of the market the rest of the way. So for somebody looking for a simple way to hedge part of their portfolio, part of their capital, the XLU is a simple way to do that and has both longer term growth potential. We're still early trend here. The turn in the XLU started back in roughly the February-March period, and is still continuing. So this is not, I do not see this as a trend that's just simply going to end, but it is an excellent place to store cash. Look for pullbacks, maybe down to the 73, 74 line if you want to get a better deal. Or I would look at owning this for maybe a 3 to 12 month period and then reevaluate. Let's see how the economy performs. But another step that we'll be taking, we will be doing a special IBL session in 2 weeks on September 23rd. So for those of you with tickets for Investors Blueprint Live, we're going to talk through how to use stocks and ETFs to hedge potential future volatility in your portfolio, and how to build a short-term plan using that approach. So if I want to take part of my portfolio and take a more defensive approach where my target in a 6-month period might be 6 to 8%, then how can I do that? What is possible? We'll look at 2 to 3 utility stocks. You can see their charts here. They have similarities to the XLU in the last several months. We'll discuss whether or not you should own them or trade them. Again, questions around options and or ownership of the stock outright. And these two stocks do have at least somewhat better option plays. Not many of them do. So again, you can use options, but don't get excited on that front, simply because of the lower volume and lower demand there. So we'll also look at using the XLU and ways that you can leverage that as part of this. So that's the bulk of our discussion. Again, keep your eye on the yield curve. If it stays in a positive, what I would call positive inversion, that is a warning sign. It is somewhat offset by what the Fed does on September 18th. Do they cut by a quarter? Do they cut by a half? The larger the rate cut, those two combined send a more worrisome signal. If it's a gradual cut, my question is, can they cancel each other out? And I would hope that that would be the case. But we want to be prepared. So this is how we start being prepared, knowing we're seeing what's possible, what could be coming our way, and then having a plan for being able to deal with it, which is why we're doing a little bit more old school approach with Investors Blueprint Live. So some keys to planning. These will be some of the things that we'll be discussing during Investors Blueprint Live this year, but you can take these away on your own and use them if you're not attending the conference. I still expect gradual, not aggressive rate cuts. I don't believe that the economic conditions warrant aggressive rate cuts. And I don't believe that the Fed will move that way, at least in September. October earnings season is going to be very important, though, and that may lead to more volatility like we saw in July, especially based on or depending upon forward guidance from companies. Remember a few weeks ago, we looked at a company and that had taken an earnings hit, and that was Dexcom DXCM, and we said, all right, so what do we do when that happens to us, and we have to evaluate from the current data. So we'll do some of that in October with you as a part of the IQ and also with Investors Blueprint Live attendees. But keep your eye on October. I think that's a more critical earnings period than July happened to be. The most important thing is to keep watch to see if this shift to more defensive areas, consumer staples, real estate, healthcare, utilities, if that continues as a trend, that is a signal to you that large players on Wall Street are moving money. We already see it and can see it in the charts in the utilities. We're working through other sectors to see if there are similarities, and we'll be reporting back on that in the September 23rd session with Investors Blueprint Live people. The last thing, and I've been kind of pounding the table on this, I guess, for the last couple of months, but small caps. Once rate cut cycles begin, I think small caps have a chance to be a winner in both 2025 and 2026 because they have been the laggard for most of this year and even last year. We talked in late last year. I shared with you who attended one of our webinars the divergence between stocks under $50 and stocks under 100 and stocks over $100 per share, and how stocks under $50 per share were absolutely not moving at all until very late last year, and even then it was only for a brief period of time. But we want to see that trend shift or change. And I do believe that the short-term rebound that the Russell had a little earlier this summer, where the Russell went up 11 or 12% in just a few days, that's a harbinger of good things. And I do think that small caps are an area where if you're a trader or an investor, you can absolutely find winning stocks in the year ahead if you have the patience to hang on to them. And as I said, we'll also be looking at other sectors beyond utilities for both growth and income in 2025. This is where I would spend most of my investing, trading, or research time in the next several weeks. Being able to plan for both a best case and a worst case. It's not easy, but a little bit at a time will get it done. And I think you'll find yourself better positioned to weather a storm if it happens, or to outperform if the worst doesn't happen, which is what we all hope it will be the case. So we'll try to grab a few questions here in just a minute. Henry asked, what if they don't cut this month? Henry, I would put the odds of no cut or no change at basically zero. Right now, the caveat to that is Wednesday's CPI, Consumer Price Index. CPI would have to move higher by a pretty sizable amount for the Fed to give pause to rate cuts. But even some of the Fed hawks, the ones those on the board of governors who have been the most hawkish about either maintaining higher rates for even longer and or even higher rates for even longer, have pulled back from their comments. The Fed is recognizing that the economy has slowed. They have if you think of a wet towel and you're trying to wring out the wet towel and the water in the towel is inflation, the Fed has wrung out everything it literally can via the rate hiking cycle that they recently concluded. The the last bastions are still in food, energy, and housing. Those are the slowest to develop. You know, energy is difficult because in one sense, you're still as a gas consumer, meaning gas for your vehicle, you're still dependent on the price of oil from OPEC. And as it relates to food costs are still higher than average. I would bitch about the cost of eggs again, but you know they're now over $4. So when we did that initial comparison, they were a little over $2. So it's a 100% increase in the cost of eggs in 10 weeks, 8 weeks, excuse me. So there, I complained about the cost of eggs again. Uh, Right. So those are the areas that the Fed can't necessarily uh, affect inflation because they're market driven. Uh, the same with the housing market is demand driven. Well, demand is lower, but prices are not necessarily coming down in either existing or new home sales, which is what we looked at with our last session in August. At the same time, new home construction is at its lowest point since 2020, excuse me, or actually it's even lower than 2020. So there are no new homes being built. So you have a decreasing supply uh, coupled with slowly decreasing demand, but in the everything from the rent to housing market, that is the slowest part of inflation to get to eradicate. And it is also the hardest because consumers again set the price of housing in the buying home market, right? And if people, I can tell you right now, we're putting up our my wife's parents' house. I live next door to my in-laws. Uh, we just cleaned out their house this past month. They moved into a I forget the correct euphemism. I think it's a community living, something like that. Um, they moved into an apartment, full service. They've got a little restaurant, blah, blah, blah. Um, but we have to put their house on the market. Well, that two houses in our block sold in the last 2 months, and the real estate agent is pricing my in-laws house even higher than those two homes because demand is high in our particular neighborhood. We have a good school district. It's a good neighborhood, good area. So that helps, but that's the hardest part of inflation. So if the CPI is anything close to normal, even if it ticks a point higher, like a tenth of a point higher, I don't think anything derails the Fed from executing that first rate cut, nor do I think they should. They should not derail at that. The labor market is absolutely weakening, and that is a precursor to recessionary conditions because if you don't have a job, you can't spend money because you don't have any, because you don't have a job. So that weakening in the labor market is not going to get lost on the Fed. Jerome Powell in the June conference, in the May and June conference, said both times he was primarily concerned with slowing metrics in both manufacturing and the services sector, which has continued through the summer. So at some point, the Fed has to step in order to execute that soft landing and not a hard landing. They have to begin easing monetary policy. That's why I make the case for gradual cuts, not only historically, but a cut now, another cut in December is just the beginning of that process, and it gives the market and the economy time to absorb those rate cuts and begin to revalue everything from mortgages to car loans, et cetera. It will take time to work through the market anyway. I have maintained that I think the Fed is late to the party, that they should have cut back in June, but so what? It doesn't matter what I think, right? I'm not part of the Fed. Uh, but that's why I don't think that the Fed is going to skip this particular meeting and not cut rates at least a quarter point. I'm more concerned with an over aggressive rate cut. Is it necessary? Not yet, not at this time. And it's like save your bullets, right? If you're the Fed, doing a quarter point now means if conditions suddenly worsen in the fall, then you have both the November and the December meetings to readdress policy, and which means plenty of time for them to go to a more aggressive cut before the end of the year. So anyway, sorry for the long over on that one. What are the y-axis scales on those charts? Y-axis. Those are percents, David. So I got cut off when I pulled these out. They're basically in 10. They were in 10% increments. So 2 years after the market was up like 40%. Remember late 1990s, late 1999 into 2000 was the big tech move. So the market was up something like 45% in that period. So and you're in the 2007, the market was down, what, 50%? So maybe they're 5%. They might be 5% markers. Somehow I lost them when I formatted the slide, and I apologize. I didn't see that when I did it, and I don't have the originals with me offhand. So let's see what else here. When are you going to plan IBL around a boat show? Well, wait, that boat show, Jim, is it's the week before in Miami Beach, isn't it? I could swear it's the week of President's Day. Or maybe it is President's Day weekend, or it's just following that. Anyway, we'll keep looking for boat shows for you, Jim. We'll find one. Absolutely. So anyway, let's finish off with pre-sale ended back on Labor Day. We are now in the early registration period for the Investors Blueprint Live conference. Just some quick details to share with everybody, and then we'll get everyone out of here or answer any other questions that y'all have. And I do have the chat from the TR Live site up, so just give me a second and I'll circle back to that from the Zoom chat and answer questions over there too. But again, February 24, 25, live or virtual, that's the main event. Be 8 to 4 p.m. roughly each day. We'll be at the Hyatt Place in Boca Raton. Easy to get to from either Fort Lauderdale or West Palm Beach, unless you're Tyreek Hill. Plenty of restaurants and shopping in the area around there, so lots to do. Great, easy to walk to too. You don't have to rent a car for the area, or you don't have to Uber if you don't want to. And the beach is about a mile away. One ticket, you can attend live or virtual. We do still have seats available. I'll give you the seat count in just a minute. And you can also change your mind. So if you book to come to Florida, your plans have to change. We can change your ticket to a virtual. It's no cost, no problem, and vice versa. If you suddenly get that 8 feet of snow, which I am predicting for everyone in the northern tier, you can change your ticket to come to Florida as long as we still have seats available. And all of our pre-event sessions, which I'll cover in a minute, those will be held virtually, just like this one here. Plus, for the first time, we are including or running an Income Madness event for Investors Blueprint Live attendees. We wanted to do something different. Income Madness, for those who aren't familiar with it, is a 5-day live trading workshop. We will trade each day, typically making 1 or 2 options trades per day, usually selling premium for income, where the objective is to close those trades within 1 to 3 days. We may have to roll past the February 25th end date, but the first 3 days will be the Wednesday, Thursday, Friday before the live event. We'll trade virtually with everyone. And then the 24th and 25th of February, we wanted to hold this at the event so that you could do this with Dave and Emily. So at the event, we'll actually do, in essence, a 2-day live Income Madness as part of the agenda, plus all of our best trading and investing ideas. And I admit, I'm going a little bit old school, but I think you're going to want this in your portfolio for next year, because I think you'll be in better shape than just relying on AI stocks. But we're going to be looking at stocks for weekly option sellers, small cap stocks, the top 3 ETFs. I talked about a couple of these over the last several months. Dave is going to be doing a deep dive on the perpetual income process. It is new for all Income Masters members, but more importantly, it's a process anyone who is selling options can use to take advantage of both puts and calls on the same stock with dividends. We'll also be talking at length about selling options on high-priced stocks and tactics you can use to do that as we continue to get priced out of stocks like Microsoft, et cetera. You need to have tactics to be able to take advantage of stocks like that, where the company is high quality. There's plenty of liquidity in the options market for those stocks, but for most people, the capital requirements are too high. So how can you still take advantage of them? And other tactics for hedging the S&P against a possible, not probable, bear market. We will have each month between now and February a pre-conference event. The first one will be September 23rd. As I detailed, we'll be talking about utilities plus 2 other sectors and individual stocks within those sectors and ways that you can trade them. Haley Bjorklund, our registered financial advisor guest, will be back. She'll be at Millionaires Trading Club and at Investors Blueprint Live, and she'll bring her own agenda, which we will post at a later point in time. Office hours will be made available for both live and virtual attendees. Office hours is a 15-minute one-on-one with the expert or experts of your choice. And if you're attending in Boca Raton, lunch is included for both Monday and Tuesday, and private reception on Monday night. Your spouse or guest is welcome to attend the private reception if you're in Boca Raton with us. So your ticket now includes 5 monthly pre-conference webinar events. You'll be doing most of these with me and Jeff. The Income Madness event, which will be held with Dave and Emily 3 days before and the 2 days of the conference. The main event, February 2024 and 25. Recordings of all sessions will be made available to you, as well as slide decks, PDFs, or any special reports which we generate. So the early registration period is now open. That will run through 11:59 p.m. Pacific time, Sunday, September 22nd, because our first pre-conference event will be Monday, September 23rd at noon Eastern. Right now, we have 17 seats remaining for attending in Boca Raton, and exactly 25 seats for virtual attendees. So we did limit virtual attendees because of the office hours, so that we can meet demand for office hours both before and after the conference. So you can still save $200 on early registration. Regular registration will go into effect on September 23rd. For anyone who doesn't have it, I'll make sure you have the link here. Give me just a second, and then we'll finish off with questions. There's a little gold box at the top of the video screen if you are in the Traders Reserve live site, or there is a URL there. And let me post this in the chat box for everybody who is on Zoom. For virtual attendees, can we ask questions which will be answered? Yes, Henry, we do make an attempt, or every attempt, to include questions from virtual attendees during the individual sessions, usually at the end of each session. So if you're attending virtually, just patience until we get to those questions. But we do call them out so that everybody can share in those questions and provide the answers during the virtual part of it. Topic of where capital flow, trillions of dollars, no other sector. No, so you can see that, but you can see that there is a substantial uptick across a range of companies just in that one sector, that one industry inside that sector of regulated utilities. I think there are 30 companies that I was looking at, and of those 30 companies, 25 of them are up, just like the XLU, in the last couple of months. Egg price is way off. Actually, at Hollywood Market, which is just down the street, my eggs were $4.29 for the cheap ass white shelled eggs. I don't know why they're $4.29 in my market all of a sudden. And I don't buy the like the Ritz-Carlton chicken eggs. I buy the old white eggshell styrofoam carton eggs because that's all I need. But yeah, they're $4.29 on Sunday. Ever thought of New Orleans? Yes, we have. And honestly, the hotels there are difficult because we typically hold the event in February, and that puts us up against Mardi Gras. And obviously hotel rates are crazy at that time of year. And then once you get past like March, it tends to be, you get weather becomes an issue in a sense. But yeah, my in-laws, my wife and I have done a New Orleans trip every year in December. We did it 3 or 4 years. Stayed at the Hotel Monteleone in the French Quarter, and then just loved it down there. It's great. Leslie is New Orleans, near New Orleans resident, so give me a chance every year to catch up with her for a few minutes in person. But yeah, we have considered New Orleans, but the hotels down there are too difficult, too expensive to try to do a reasonable or reasonably priced event. So I think that Miami boat show is 2 weeks after. Maybe we'll have to do this in March next year. We'll have to try again. We promise, Jim. All right. Think that's what I have for the day today. We'll be back next week with some more valuation and a couple of stock ideas for you. And then September 23rd, we'll be off air as we start the Investors Blueprint Live pre-conference events. And then I'll give you a new schedule for October for IQ as we get to the end of this month. So have a safe week out there in the markets. Glad to see a little bit of an uptrend today, and let's hope it continues through the rest of the week. But thanks for taking the time to join me. We'll have a recording out to everybody probably a little later tonight or first thing tomorrow. So thanks again, folks. Have a great night.